All right, so I think we are getting ready to go live here. I'm going to go ahead and pull these slides up, and hopefully people can see those on their screen. We're talking today, welcome to this webinar, this Facebook Live on market update, a KCM market update, the four biggest questions right now in the market. So I know we have a lot of folks that want to join today, so I'll give some time here and let folks join. We're going to be talking about the questions that people are asking right now and giving you the answers to those questions. And as we get ready to do that, I want to say a couple of things. If you're on here, please share the slides. Please share so that we can get as many, as much of this information in the market as we can, and share this broadcast. As well, as you're looking for the resources, you can go to keepingcurrentmatters.com/coronavirus and get all the information, and that page will be updated. We will be doing things there as each day goes by, putting the most recent current information on that page so that you have everything you need to answer these questions. Let me look here with our team. It looks like we have folks joining, and we're getting ready for this. So as we get started, I am thrilled today to have alongside with me Steve Harney, the founder of KCM. Many of you know Steve as the founder, but not only previously owning his own 500-person agent company, before that being a top agent in his market. And really in times like this, really 12 years ago when KCM was founded, was to give the answers to the questions that people had in the market. So Steve, thank you for being a part of this today.
Hey, listen, David, thank you very much. And I want to thank everyone that is coming on to this Facebook Live. You know, very obviously we're in trying times, and the best of us are going to get us through this. So I really appreciate everyone taking the time to invest in learning what they need to do to talk to their clients and their customers during these trying times to relieve some of the anxiety and some of the panic that might be in the market right now.
Absolutely, absolutely. So as we get started today, really as folks join, again, I'm going to say this as well, share this Facebook Live, share what we're doing. And our goal with these resources is to give you the resources that you need out in the market to communicate effectively. And right now, in a time of uncertainty, people follow the certain. And so what we want to do is we want to look back on what's happening in the market and really give you those answers. So let's go ahead and get started here. And Steve, I'll kind of shift it back over to you, and maybe you guide us through some of the questions that we're hearing, and I'll take the approach of driving these slides and really kind of going after those.
All right. For those that don't know David, because he's relatively new to this part of our business, but I want to let you know that my relationship with David goes back 12 years. In 2008 and 2009, I really understood what was taking place from the housing industry side of it. But what was impacting the housing industry was very obviously the market, the stock market, and the mortgage industry. And I wasn't as well versed in those. So I took David on as a consultant, friend, mentor, to help me go through some of the things I didn't understand as well, so I can communicate that to you. And he did a phenomenal job helping me help you through those times. Then, it was like, I got to get this guy, on the team. And I tried for 10 years with no avail. David, it was very well wanted. He sought after. He's got his, degree in business from Georgia State. And, one of the jobs I was trying to drag him out of is he was on the leadership team for the national sales team for one of the 4 largest banks in the country. He understands the mortgage industry. He has a good understanding of the financial markets, and he understands, what's taking place in the foreclosure market. So we went after him, and 2 years ago, we landed him. And part of the reason we landed him was we knew eventually the longest recovery in American history was going to, at some point, come to an end, and there was going to be some rockiness. Who knew that the coronavirus was going to bring us there more quickly than we thought. But thank God David is on the team, and thank God he's here today to help us really understand what's going to be taking place and how we can best counsel our clients. So David, let me jump at the first question.
Perfect.
Part of the challenge is this is not a challenge in America. There's global uncertainty across, the whole, globe, the whole earth. And the people that are having that uncertainty, they're bailing out of the stock market. And what are they doing with that money, and what does that mean to housing?
Sure. It's the question I think on the top of every one of our minds right now, and the way I want to start that conversation is really talking about a couple of things that as we have KCM members on here today. I'm sure we have some folks on that aren't KCM members, but if you're a KCM member, you've heard us talk about this, and I want to hop to a slide here that shows the relationship between the 30-year mortgage rate and the 10-year treasury rate. So when we go back to that, Steve, when we see money coming out of the stock market and it's what it's doing is at that point flowing into the bond market, the US Treasury, widely considered the safest investment in the world. And so when we look at that, when we look at the 10-year treasury rate, which is what predicts mortgage rates, and to prove that, we went back 50 years, the KCM research team went back 50 years and tracked the 30-year mortgage rate to the 10-year treasury. And what you see is we see this symbiotic relationship that the two move in together. And so while there's a lot of information out there, and we get, maybe a loan officer gets a question when the Federal Reserve lowers the Fed funds rate, what does that do to mortgage interest rates? We know it doesn't have a direct correlation, but it's the 10-year treasury. Well, the interesting thing is, while we know that is true, that changed last week. And it's really changed to the extent that there have been other forces at play in the market. And as the 10-year treasury rate has dropped, mortgage rates have not followed. In fact, we're in a volatile environment right now where we're seeing pricing go back and forth intraday. And there's a lot of people that talk about that, but now more than ever is the time to have somebody trusted on your side that can give you that great advice as a mortgage professional. But I want to hop into a quote real quick from First American that we can talk about for just a second. And it said, as evidenced by recent events, often the spread increases, that's a yield spread, because mortgage refinance application processing capacity cannot meet demand. So lender offered rates don't follow the treasury yield down 1 for 1. So while the mortgage rate has declined in response to the decline in yields, it's unlikely to fall by the same magnitude as the treasury yield. It's plausible that mortgage rates fall further if the benchmark 10-year treasury bond declines further. And it's reasonable to expect that rates will fall even further and likely surpass the prior record low, but not necessarily 1 for 1 with the 10-year treasury. And we know right now in everything happening in the market that we're seeing some things happen on a daily basis. Why it's so critical right now to have somebody on your side in the mortgage profession to be able to get the best advice and best rates from. But let's look at that over the last year from the rate environment. This is a graph that our team put together showing the 30-year fixed mortgage rate from June 2018 up until this past week. And certainly we know that that's even volatile in this. This is not meant to be an indicator of where the rate is at, but just to show that flow going forward. So the answer to the question, Steve, in the volatility, we're seeing a lot of things in the market right now that are different than what we've ever seen. But we know that going forward, we should be able to look at the 10-year treasury as we look out into the future.
All right, thanks a lot for that explanation, David. When you gave it to me, it helped me understand it a lot. And ladies and gentlemen, interest rates are still really low from historic numbers. They're very low, more than a point down from where they were, in December of 2018. So people are still getting a great rate. They might not be getting that unbelievable rate that, that 3.29% that was 2 weeks ago.
Yeah.
Now, David, what you talked about is, all right, the reason this is happening, the reason interest rates have come down is, especially recently, is that, the stock market had 2 of the worst weeks it's had, 2.5 of the worst weeks it's ever had.
Right.
And what, agents are asking me, because consumers are asking them, is, well, when the stock market goes down as quickly as it is, doesn't that have a tremendous impact on home prices?
Sure. And I think that is the question on a lot of consumers' minds right now. And we have to look at the fact that, and we've done a lot of this. If you're a KCM member, you're prepared for this. It gets into that question of, will this be just like 2008 all over again? So what our team did was we put together a couple of visuals that members can use to go out and really start to show people what is happening. So let me go to a graph that our team put together. And it compares the housing and mortgage crash of 2008 to the S&P correction at the same time. And so when we look at that, we see the S&P correction at 51% over that span of time. And then we see home prices depreciating just under 20% during that same time. So that I call it a lot of times that scar tissue that we have when we hear slow time, when we see the stock market reacting, that we go, oh gosh, are we about to see home prices depreciate? And it's a question, Steve. You and I were talking, and I was sharing with you the question, the phone call that I had gotten of somebody who was in contract saying, a dear friend, longtime friend, saying, what should I do? And those are the types of questions we're getting right now. I'm sure you guys have gotten those as well. And being able to bring some perspective to this conversation, I want to switch to a quote from economist Dave Rosenberg. And what it starts to show is there's a lot more in common with 9/11 than there is in 2008 when we start to look at these crises we faced. And he says what 9/11 has in common with what's happening today is that this shock has also generated fear, angst, and anxiety among the general public. People avoided crowds then as they believed another terrorist attack was coming, and are acting the same way today to avoid getting sick. The same parts of the economy are under pressure: the airlines, leisure, hospitality, restaurants, entertainment, that consumer discretionary service that's, just in general. And I think we all have looked at that over the last few days and go, okay, look, there's some people being impacted very hard, and we feel for those. And yet from it happening in an event is much more like 9/11 than 2008. So what our team did is we went back and we looked at the .com crash and 9/11, and then looked at housing as well, just like we did with 2008. So let me hop there. So when we start to look at that, we can see an S&P correction, and we can also see the housing market. The S&P correction there, you see at 45%, but then we know cumulatively over the same time, housing appreciated almost 24%. So very different in the way that housing reacted in the 9/11 crash and the .com crash versus what housing did before. So that's the thing we want to be able to deliver. And in today's environment right now, the old saying is a picture's worth 1,000 words. And today, you've maybe seen it trending that a video is worth 1,000 handshakes. And so whatever we can do to get these visuals in front of the people that we serve is going to help tell that story, and tell that story of how today is different than 2008. And I know we're getting questions about where we can get those. I want to go back real quick if you missed it. We've got a resource site that is keepingcurrentmatters.com/coronavirus, where these slides are at, and you can grab those as well. Steve, you still here with me?
Yeah, I'm still here with you. All right. I didn't know if you're going to go back to the previous slide or not. So basically what you're showing us very visually is it's not unreasonable to say, if this is a lot more like 9/11 than it was in 2008, then the housing market is probably going to react a lot more like it did after 9/11 and the dot-com crash than it will in 2008.
Absolutely.
And we can see, ladies and gentlemen, that the stock market, as far as annual home price appreciation, reacted very well, during those times. And I think that we can see similar situations now. Obviously, we had a tremendous start to the year. Just this morning, the existing home sales report came out and showed that we had the highest number of houses sold in the last 13 years on a monthly basis, or an annually, it's seasonally adjusted basis. And that's good news. Now, we know that because of what's taking place right now, those numbers are going to slow up as we're forced to slow up and shelter in place or change our business model a little bit. But, when this thing is over, and it will someday be over, and, when that time comes, we're going to come roaring back. So I think that these numbers, again, are not unreasonable to expect to take place now, even though we're in a stock market situation. But some people are also worried, not just about the stock market falling, David. What they're also worried about is, with everything happening and everything shutting down, will we be heading toward another recession? And what does that mean?
Sure. And I think when I start to think about this, and I think about the conversations that we've had with KCM members, the blogs that we've written about this in the past of, hey, the talk of recession, the reality is where we are today, we all can feel the slowdown. We can see the slowdown. We can see it in towns that have said, you're going to shelter in place. And we know that is and is going to continue to have an impact on economic activity. So the interesting thing is, when we talk about this, a recession is a slowdown in economic activity. When we talk about it with our clients, when we hear the word recession, we all immediately have these ideas and these thoughts of what the prior recession was. That's just the reality of the world we live in. If we talk about an economic slowdown, it's very different. And I think keeping that in mind as we talk about it is critically important right now. But let's hop in to see what experts are really saying right now. And I want to start with a quote from Bill McBride. And it says, with the sudden economic stop and with many states shutting down by closing down bars, schools, bars, and restaurants, my view is the U.S. economy is now in a recession that started this month, and GDP will decline sharply in Q2, and Goldman Sachs is forecasting this, and the length of the recession will depend on the course of the pandemic. So what's Bill saying there? Certainly we are seeing that and feeling that economically right now. We are feeling a slowdown. And we can start to see this is going to go on until, through the course of this pandemic. Steve, we talked a lot about this. And if I had to draw a picture between, 2008 and where we are today, is 2008 was like a tornado came through our town and ripped apart buildings, ripped up telephone lines, ripped up things that had to then slowly be rebuilt over time. In that analogy, what we're experiencing today is a heavy snowstorm. It's shutting things down. But what we know is that as time goes on and that snowstorm starts to let up, things will reopen again. The courthouse will reopen. Restaurants and bars will reopen. We'll be able to go to a baseball or a basketball game. And the biggest problem there is going to be, can you get a ticket to that game? Because everybody's going to want to go out there and do that. People are going to want to get out of their homes and go and have a nice dinner. And so really, when we look at that graphically speaking, Goldman Sachs starts to show this V of a recovery versus a U, like what we saw in 2008. Really a sharp decline and then a a sharp increase with further strong gains going into 2021. And when we look at it, experts, Wells Fargo agrees as well. They say here in this quote, "We do not expect a repeat of the severe recession of 2008 and 2009 because the virus and oil shocks are not endemic to the financial system, but are rather external. And once the virus infection rate peaks, we expect a recovery to gain momentum into the final quarter of the year and into 2021. So
David, I
go ahead.
love your analogy that you came up with about the tornado ripping everything apart, and we had to rebuild everything all over again, because that's what happened in 2008. The financial systems that we depended on got ripped to shreds, and it took us, in some cases, 5-6 years to rebuild them. That's why it took so long for the recovery. I like that you're talking about it as a snowstorm, meaning it's causing the same slowdown in business while that snow is here. But as that snow starts to taper off and eventually melt away, we don't have to rebuild any buildings. We don't have to rebuild our financial system. It will just immediately kick in. And that's why there's that V, curve versus the U curve. Yeah. But it will still have been technically, by definition, and I like what you said, let's not use the words recession, let's use the definition of the word recession, an economic slowdown. But if that does happen, what is the history? You've done a great job with your research team of coming up with this next slide that I've seen that blew me away. Every agent should have this slide. Every agent should be putting this slide out. Every agent should, any marketing you're doing, any video you're doing, any Instagram post you're doing, any mailing you're doing, you have to have this slide with you. So show them that slide, because this was remarkable to me about what really happens to house prices during a recession.
Right. And you're absolutely right, Steve. Using this wherever we can to get the word out about recessions and what has happened in the housing market during those recessions. So many of you have seen this before, some of you haven't, but we went back and looked at the last 5 recessions. And what we know is in 3 of those 5 recessions, home prices actually increased. In one recession, in 1991, we saw a slight decrease, but what we remember is 2008. We saw a significant decrease, almost 20%. And so getting this message out that recession does not equal housing crisis, recession is an economic slowdown. We can see it right now. We see things closing down. Yeah, it makes a lot of sense that we would be going into a recession, and that would be the term that would identify that. So this slide right here, it's been out in the market. Again, people have seen it, but just because we have seen it, I think the important thing is not to fall prey to the curse of knowledge and say, well, I know that and I've seen that. I don't know that our clients know that. I don't know that people out there every day know what happened in the housing market in those last 5 recessions.
And David, you're right. What we did is, when we knew originally one of the reasons we brought you on board is we knew eventually the recovery was going to at some point come to an end, because every recovery does. So we had been, and you were leading the team, to do a lot of research on the recessions and what impact it's going to have on housing prices. And we have put this out before to let people know. But I will tell you, ladies and gentlemen, even if you've done this before, what we have to realize is there's a much more acute realization that there is an economic slowdown right now than there was when we were telling you it's about to happen. So I think that, as that old saying goes, the student will appear, the teacher will appear when the student is ready. We've been helping agents understand this for a little bit of time now. So that teacher's been ready. All right. The student is now ready to take this in. So let's make sure we get that out there. So, good job, David. What you've done with the research team since you've been here has been really remarkable. First, building the personnel in the research team, training them to, letting them know what to look for. All the materials we have is so upgraded and so up to date and so easy to understand that, you've done a phenomenal job. I just want to thank you.
Yeah, and I want to say something on that because it is the power of the KCM research and content team, the entire KCM crew that supports what we do every day.
And that's what, like just about 25 people now?
25 people that support the operation of everything that we do. And to that point, we are working day in, day out to say, okay, what is happening in the market to bring you the visuals that matter. We're going to be doing this again, going on Facebook Live as often as we need to update that message. When we have information that we're looking at, and we're looking at things right now, we're looking at home sales during times when there's high unemployment. That's a question that we have right now. And we want to be able to deliver to you, hey, let's look back on that. Let's derive some answers in times like that. But Steve, to your point, the amazing KCM crew that puts this together is worked really, really hard and diligently this week to bring the best information to help make sense and to give answers where there's a lot of uncertainty. And I'm extremely proud to be a part of that and be a part of the team that's helping there.
Well, you've really done a remarkable job of upgrading everything we've done, and again, as the founder of the company, knowing that its reputation, its brand, its legacy has been so dramatically impacted by you coming in and doing what you've done. I really truly appreciate it. Now, one last thing, because let's get back to what's always been important to me right from the beginning. It's not necessarily, the agents are going to be fine. We're going to keep on doing what we're doing. But 2008 devastated a lot of families.
Yeah.
A lot of families lost their homes, right? The foreclosure situation, economically it was devastating. There's no argument about that. But having to grab your kids and tell them we have to go now, because there's a sheriff at the front door, grab some of your clothes and some of your toys. And that kid had two questions. Maybe he was 6 years old, asking his mom, why do we have to go and where are we going? And the mom might not have had an answer to either one of those two questions once the kid asked. We're still feeling ramifications of people that went through that time. Yeah. We're not going to let that happen again, I know, but let's let people know why we're not going to see that same devastation, family devastation that we saw the last time.
Yeah. That question there, and Steve, you mentioned you and I meeting in 2008, and you're forming KCM, and the cornerstone of KCM being formed is to help families feel confident when buying and selling a home, confident in this process. And all the things that you talked about, it's in times like these where all those memories come back for us. Many of the agents that are on this Facebook Live today were, in the business in that time, and we all remember that time as just a very uncertain time, and things were happening at the speed and pace that we can make sense of it, and really KCM came in and gave those answers, and was a big piece that just drew me to it. And so I'm grateful for that. But let's talk about today, and because I think there is a current back to 2008 and some of the things. And let me start here from announcements from the Federal Housing Administration, FHA. So FHA has indicated it is enacting an immediate foreclosure and eviction moratorium for single-family homeowners with FHA-insured mortgages for the next 60 days. The next line there says the Federal Housing Finance Agency, FHFA, announced that it's directing Fannie and Freddie to suspend foreclosures and evictions for at least 60 days. So what are we seeing right here? We're seeing things that in 2008 we got wrong, that you're seeing legislation, you're seeing the government respond to that, to the need that our industry has and that consumers have, so that we say, how do we not have that happen again? And this came out on Wednesday. I think we're seeing banks start to respond to it as well. There's a lot more to be written there of how they're going to respond individually to borrowers in those situations. But action like this, we start to look at that and go, that's very different from 2008. But there's also structural things we can look at in the process that are very different from 2008. And I want to hop to a couple of slides to really show that. The first one is where were we in 2008? And if you remember back in that time, we had seen, you can see here, $824 billion, billion with a B, in cash out refinances. And people are largely using their homes as an ATM machine, taking cash out, harvesting equity from their home, a lot of times putting that into depreciating assets and going, this is going to go on forever. But when we start to look at today, in the last 3 years, we can see cash out refinances are a fraction of what they were leading up to 2008. Really, the underlying storyline there is people started to learn their lesson. People are not doing what they have done in the past with the equity in their homes. And we know today the equity position across this country is very different than what it was in 2008. We know that over 50% of the homes in this country have over 50% equity. People aren't walking away from that. In 2008, people started walking away from homes when they have negative equity, when they were in situations where they owed more than the home was worth. We're in a very, very different situation in this country today than what we were then. And as I think about that, and I think back to that time and what you said, Steve, and starting KCM and being able to really deliver this information to agents across the country so that you can get this information out in the market is what this is about. There's another graph that I want to
before you jump to that, David.
Yes.
I just wanted to go. David's so much more polite and gentlemanly than I am. So I just want to reword in Steve Harney words what David just said. Back in 2008, the government was stupid. We were too slow and we were too small in our response to the pain that homeowners were feeling. And to share the blame, the homeowners were pretty stupid too, because they were using the house as an ATM to do stupid stuff with the money instead of leaving it in the house and letting that equity build. And what David just explained to you, both the quotes and the graph, luckily, the American people and the American government learned from those lessons, and they're not going to let that same thing happen.
Yeah. So important to look at that. And I could point people back, if you didn't read the blog this past Monday of the 5 reasons why this isn't 2008, you need to go back and read it. This is one of the reasons, but we looked at, credit, we looked at appreciation, inventory, income, and really let's talk about income for a second, because as we started out this year, we've seen a market where income is rising and mortgage rates have been falling. And what that has created is a drop, and we're really historically 21.2% of someone's income would be dedicated to their home, to their mortgage. And right now, what we've seen leading into this is that number is about 14.8, significantly lower than the historic norm, speaking specifically to the leverage of the consumer relative to housing. And so again, going back to Monday's blog, you can read more on that to see those reasons. And they're ones that taking these visuals, recording a video, sending an email, mailing something out, doing something right now, because now is the time to do that. And Steve, you talk about that. We were talking about it the other day of just how agents can, coming into this market, how they can make a difference and bring current information to the people they serve.
Yeah, I think that I'll say 2 things. The first thing I'll say is, ladies and gentlemen, many of you have spent a lot of resources, time, energy, and money building a brand as a trusted advisor. You were the person that you wanted your community to come to if they had any questions about real estate, and that's really, really cool. All right, and many of you successfully built that. But I will tell you something about a brand. It'll take you a long time to build it, and it'll take you seconds to lose it. So right now, ladies and gentlemen, if you've been telling people that you're the trusted advisor, please don't hide. Don't slow up. Go at them strong. Now, I realize that there's some limitations as to what you can do as far as physically, but you can still mail, you can still call, you can still do videos, you can still do Facebook postings. And please make sure that they're relevant to what's happening. Ladies and gentlemen, if you're posting great real estate information right now, taking the fear out of the consumer by answering the questions that scare them the most, well, then you'll be top of the mind when this thing settles out as the real estate professional they should go to. If you're posting comedy, you're top of the mind as a clown. All right? If you're posting, as some agents unknowingly did yesterday because they were on automated service, you're posting that you can get a discount going to the movies with a picture of 100 people sitting in 50 chairs in a movie theater sharing popcorn, when we're talking about states shutting down so that you can have the proper social distancing. Well, if you're posting that right now, you're being insensitive and, another Steve Harney word, stupid. Don't let that happen. If ever there was a time that you wanted to post, great information, it's now. And the simplest way to do that, and I don't care how long you stay on, from now until the end of this year, because we have the coronavirus, we have a very highly contested presidential election, and there's the whole recovery. You jump into KCM and get some good stuff out. Don't let the last 5 years of what you've done be lost in the next couple of weeks. Don't let that happen.
Yeah, it's such a good point. I'm gonna share my screen again, Steve, because to do that, I mentioned this on the front end. We've created a site, keepingcurrentmatters.com/coronavirus. We are updating that with the visuals, with the things that you need to answer these questions. When you go there, if you're a KCM member, you can log in, share everything personalized, and do everything that you know how to do. But it's also out there for our industry. We want to help people right now. And so to do what Steve's talking about, be informed, be there, and we're going to continue to update that. We're going to continue to do these Facebook Lives at the frequency that we have information and things that we can bring to you as this shifts. Literally, the different webinars that we've done this week, things have changed as we've gone day by day. Sometimes in the actual webinar, some information is shifted, whether it be a projection, whether it be something that's updated, and getting all of that information to you so that you have that relevant market opinion out there right now is our goal for you. And it's really through that goal that you would be able to deliver that and capitalize, like you said, Steve, on that brand that you've built. So with that, I'm gonna wrap up our time. Know that our team is here to serve you however we can. Reach out to us. Let us know how things are going. Tag Keeping Current Matters on Facebook and Instagram. Use the hashtag Keeping Current Matters. We'll repost as much as we can to get the message out in the market, because that's what we want to help you do. We want to help amplify that. So we appreciate you joining, and we will let you know when we're going to do another one of these, but look for more information. Go back to this page, keepingcurrentmatters.com/coronavirus, as it's updated. The slides from today are on there, and we look forward to seeing you again on one of these soon. All right, bye-bye.